uncertainty, the Indian economy is in a good spot with strong growth and low inflation. Inflation remains below the tolerance band and its outlook continues to be benign. High-frequency indicators suggest continuation of the strong growth momentum in Q3 this year and beyond. With the signing of a landmark trade deal with the European Union and the US trade agreement in sight, growth momentum is likely to be sustained for a longer period. Global growth, supported by tech investments, accommodative financial conditions, and large-scale fiscal stimulus, is expected to be marginally stronger this year than projected earlier. However, the confluence of escalating geopolitical frictions and rising trade tensions is unraveling the existing world economic order. Inflation outcomes are heterogeneous across jurisdictions, remaining above target in most advanced economies, prompting divergence in monetary policy actions as central banks near the end of their current easing cycles. Against a global backdrop that has increasingly become more cautious, bond market sentiments remain bearish, reflecting fiscal sustainability concerns. However, equity markets driven by tech stocks remain upbeat. The Monetary Policy Committee met on 4th, 5th, and today to deliberate and decide on the policy repo rate after a detailed assessment of the evolving macroeconomic conditions and the economic outlook. The MPC voted unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the MPC's decisions. The MPC noted that since the last policy meeting, external headwinds have intensified, though the successful completion of trade deals augurs well for the economic outlook. Overall, the near-term domestic inflation and growth outlook remain positive. Headline inflation during November and December remained below the tolerance band of the inflation target. The revised outlook for CPI inflation in Q1 and Q2 of next year at 4% and 4.2%, respectively, revised slightly upwards, continues to be benign and near the inflation target. The slight upward revision in the inflation outlook is primarily due to increase in prices of precious metals, which contribute about 60 to 70 basis points. The underlying inflation continues to be low. On the growth front, economic activity remains resilient. The first advanced estimates suggest continuing growth momentum, driven by domestic factors amidst a challenging external environment. The growth outlook, too, remains favorable. Based on a comprehensive review of the domestic macroeconomic conditions and the outlook, the MPC therefore was of the view that the current policy rate is appropriate, and accordingly it voted to continue with the existing policy rate. It also agreed to retain the neutral stance. Going forward, the MPC will be guided by the evolving macroeconomic conditions and the outlook, based on the data from the new series in charting out the future course of monetary policy action. You are all aware that in a few days we will have a new series for both GDP as well as inflation. I will now dwell on the assessment of growth and inflation. First, growth. The Indian economy continues on a steady improving trajectory, with real GDP poised to register significant higher growth of 7.4% this year as compared to the previous year. Amidst global headwinds, private consumption and fixed investment both supported growth. Net external demand, however, remained a drag, with imports outpacing exports. On the supply side, growth in real GVA on the back of a strong contribution from the services sector and revival in manufacturing activity is estimated at 7.3% this year. Going forward, economic activity is expected to hold up well in the next year. Agricultural activity will be supported by healthy reservoir levels, robust rabi sowing, and improvement in crop vegetation conditions. Improving corporate sector performance and sustained momentum in informal sector should boost manufacturing activity. Construction sector growth is expected to remain firm. Services sector should continue to be resilient with strengthening domestic demand. Early results from IT firms suggest an improvement in business activity. On the demand side, the momentum in private consumption is expected to sustain next year. Rural demand remains steady with improving agricultural activity and rural labor market conditions. Recovery in urban consumption should further strengthen, with continued support from GST rationalization and monetary easing, among others. High capacity utilization, accelerating bank credit, conducive financial conditions, and government's continued emphasis on infrastructure should give an impetus to investment activity. Moreover, several measures announced in the budget should be conducive for growth. You are all aware that one of the kartavs, one of the pillars in the budget has been on sustaining growth. The recently concluded India-EU FTA and the prospective India-US trade deal, along with several other trade agreements, will support exports over the medium term. Services exports should remain resilient. The spillovers emanating from geopolitical tensions, volatility in international financial markets, and shifting trade patterns pose risks in the outlook. Taking all these factors into consideration, real GDP growth projections for Q1 and Q2 of next year, that is 2026-27, are revised upwards slightly to 6.9% and 7% respectively. The risks are evenly balanced. I may mention that we are deferring the projections for the full year to the April policy, as the new GDP series will be released later in the month. I now come to inflation. Headline CPI inflation remained low in November and December, even as it firmed up by 1 percentage point in these 2 months. This increase was largely driven by the lower rate of deflation in the food group. Excluding gold, core inflation remained stable at 2.6% in December. Near-term outlook suggests that food supply prospects remain bright on the back of healthy kharif production, sufficient buffer stocks of food grains, favorable rabi sowing, and adequate reservoir levels. Core inflation, barring potential volatility induced by prices of precious metals, is expected to be range-bound. Geopolitical uncertainty, coupled with volatility in energy prices and adverse weather events, pose upside risks to inflation. In terms of the headline inflation trajectory, despite the anticipated momentum being muted, unfavorable base effects stemming from large decline in prices observed during Q4 of last year, that is 2024-25, would lead to an uptick in year-on-year inflation in Q4 this year.